I'm going to share with you the secret on how we can make over $165,000 or more per year and pay zero in federal income tax. It's a pretty awesome strategy. It's called a cost segregation study. Some people talk about it. A lot of people have no idea this even exists. And the crazy part is the government incentivizes us as real estate investors to buy real estate, provide housing for people, have rentals, keep the economy going, right? Construction, all that good stuff. So once you understand that the government is incentivizing you to buy real estate, then you start learning about the tax code, how it works, like how are the wealthiest of the wealthy making the most money and paying the least in taxes versus sometimes people that make the least amount of money or maybe middle income, right? They make 40, 50, 60 grand a year. Those people are paying the most in taxes, more than the Jeff Bezos and the Elon Musk of the world, right? How is that even possible? Well, obviously there's business deductions. People, form LLCs, S corporations, things like that. But in this video, we're talking about real estate specifically. So let me break down what a cost segregation study is and how it can help you avoid paying taxes, at least in the short term. So when it comes to a cost segregation study, right, when you buy a rental property, in general, there's something called depreciation, which is just essentially the government acknowledging the fact that over time, the building that you bought, right, because there's the land and there's the building when it comes to what is considered the property or the real property. So when you buy a building, it's going to depreciate over time, not in value, but as far as the things that you're going to have to fix to keep it up, right? The roof, the HVAC, flooring, whatever it is involving the building, those things are going to, deteriorate over time where you got to have to repair them, fix them, replace them, right? So the government acknowledges that and allows you to depreciate the building value over 27 and a half years. So, and again, I'm not a CPA. I'm not your CPA. So do not take this as your financial advice. Please consult your CPA. But this is what worked for me. So knowing that, let's use an example. A house we bought, $600,000 house. Generally, the building is going to be anywhere from 75 to 80% of the property value. So let's say you take that $600,000, multiply it by, let's say, 80%. That's going to give you a value of roughly $480,000 for the building. Okay, that's what you can depreciate. The other 20%, $120,000, that's for the land. Okay, so this $480,000 number is what we're going to focus on because that's what we can depreciate. That's what we can take deductions on. So we take that 480, divide that by 27.5, and that's going to give you a yearly number that you can essentially write off on your taxes. I don't have that number in front of me. It's probably, if I had to guess, 13, 14 grand, something like that a year. So you can do that. And if you have multiple properties, let's say you have 10 properties, each, 14 grand off a year. Well, there you go. There's 140 grand. You're almost writing off all your income for that year if you made 165. So that's one way to do it. That's not what we're talking about in this video, though. A cost segregation study, right, and with the big, beautiful bill that just came out, allows you to take the majority or a good bit of that up front in year one. So this purchase of a house that's worth $600,000 allowed us to write off $165,000 of our income this year alone, which is crazy. You think about that. You can make $165,000 and pay zero in taxes. Unreal. And that's what real estate allows you to do, especially creative finance. When you can buy a house, this house, we use none of our own money. We use private money lenders. The seller financed us at 0%. So we're in the deal, no money, yet we're the one that gets the tax benefit. It's crazy. So I wanted to break this down because it's a powerful concept. It's something that I knew nothing about. Getting into real estate, I was thinking about cash flow. I'm thinking about appreciation, the loan pay down. All these things are amazing. But when you start thinking about how this can change your life, think about what your effective tax rate is on $165,000 income or more. Let's say you're making 400 grand. What's your tax bill now? 150 grand, 200, depending on what state you're in. Could easily be 40, 50%. So what is it worth to you to learn these strategies, to be able to learn creative finance and buy real estate so that you can avoid paying taxes, at least right now, and I'll get to that in a minute. so that you can keep that income every year and keep reinvesting it into your business and to buy more rentals and getting more depreciation, right? What's the con of a cost segregation study? Again, I'm not a CPA. I'll give you what I know about it. Number one, by taking some of it up front, you are ultimately taking a little bit less over time, right? So if you take the brunt, let's say you take that $165,000 in year one, the remainder you're kind of discounting, essentially, from my understanding. So that's one con, but I would rather save money now than save money later. That's how I think about it. The second thing is you're going to have something called depreciation recapture. So you don't just get away with not paying the taxes, right? The government's kind of giving you a pass for now, right? So that $165,000 that we wrote off in year one, well, when I go to sell the property, that affects what they call your cost basis in the deal. So when you go to sell it, you're going to still have to pay the taxes on that 165 when you go to sell. So let's say writing that off this year saved us 40 grand in taxes, for example. Well, when I go to sell it, I'm going to have to pay that 40 grand plus any kind of appreciation, any kind of equity that we've built over time, right? So that's something you got to think about. But I mean, the question is, like, would you rather pay 40 grand now or 40 grand in 10 years when you sell it? In my opinion, I'd rather pay it 10 years from now, right? Because what can you use that 40 grand for now in your business? How can you use that to leverage and buy more property, or just to have more security in your business, right? Or for your family. So the other thing you can talk about too, don't want to get too heavy into it. I kind of want to make this a somewhat of a shorter video. But one way to get around that depreciation recapture is to do what they call a 1031 exchange, which is where you are essentially selling the property to put that money directly into a new property, right? So instead of you selling the property, the cash hitting your bank account, and then you take that money, 3, 4, 5, 6 months later, and then go find another property, once it hits your bank account, you're paying the taxes. That's received income. You got to pay taxes on that, unless you can find another way to write it off, right? So the better way to do that, if you're looking to avoid taxes, maybe even throughout your life, is to do 1031 exchanges where you have a third party, essentially, that allows you to sell the property. You have to essentially acknowledge, okay, I have 2 or 3 properties that I think I'm going to replace, and I'm going to put this money into that one. And they essentially just help you roll it into the next project. Whether it's a home or maybe a duplex or a triplex, right? And the cool part about that is when you do that, you don't have to pay the taxes. And you can just keep doing that and doing that and doing that over and over and over, to the point where a lot of people, they kick that tax can down the road until they essentially pass away, give those assets to their next of kin, and the next of kin never has to pay that depreciation recapture because they get it at a new cost basis. So it's kind of a crazy game that people play. I'm not saying that's the game I'm going to play the rest of my life. I haven't made that decision yet, but I am telling you there's this powerful, powerful thing in real estate, and it's the tax benefits included with all the other things that build your wealth. So we do talk about all these things in our free school community. We talk about creative finance, how to find the deals, how to fund the deals, how to look at real estate in a different way besides just cash flow and appreciation, right? And really just doing real deals with real people, working on an active deal right now with someone in the community I'm really excited about and want to continue to grow this thing. So if you have questions, please comment below your questions about the tax benefits in real estate or any other questions that you have. Definitely share the video, subscribe. I'd really appreciate it as we try to grow this channel, and hope you have a blessed day. Thanks.